interesting episode today. I have with me Prateek Agrawal sir from Motilal Oswal, and the interesting day as well because just अभी यूनियन बजट आया है, मार्केट्स आर एट ऑल टाइम हाई. कुछ लोगों को सोच रहे हैं कि मार्केट बहुत भाग गया है, कुछ लोग कह रहे हैं कि देयर इज अ लॉट ऑफ पोटेंशियल लेफ्ट. सब कुछ हम समझने की कोशिश करेंगे प्रतीक सर से. सर, द माइक इज ऑल योर्स एंड वी आर हियर टू लिसन एंड लर्न फ्रॉम.
Thanks, Vishu. Good morning, everybody. Let me have 15 odd minutes, 20 minutes. I'll take you quickly through the major stuff that happened in the budget and set the context. Yeah, so the first thought is this is a time for alpha. We have been saying this for a long while. And the reason why we have been saying this is our belief that markets follow earnings growth. And if you see over the past period from 20 onwards till now, large caps have done well, 20 odd percent growth, but mids have done better, 36, smalls have done even better. So managers generate alpha by moving from large to mid to small, getting that flavor into their portfolios, and that generates alpha. So one thought was whether the budget has done anything to destroy this. We will see that, but the small short answer is no. The buoyancy in the mid and small was witnessed, one on account of China plus one thought, the protection that the world over governments are able to provide to their businesses. Two, because of a manufacturing renaissance that we are seeing in this country, which is also a takeoff from China plus one. And three, because of several new spaces that have come about, for example, new tech, for example, EMS, renewable, and so on. And for most of the newer spaces, there is something positive in the budget. So, for example, for new tech, if you wanted to do angel financing or private equity, it is now better. Taxation is lower. Renewable expenditure in the budget has been increased, and so on. So, now, whether the budget does anything to change the long period trend. So, a lot of times we hear people saying कि ये trend अभी हो गया, market pauses, there will be emergence of a newer trend. Our belief is trends don't change in a short period. Companies may change because, some companies may become very expensive. Companies may change, but trends don't. So the capex driven trend, so this is gross fixed capital formation. You see it increasing 8 years on a trot, 2000 to 2008. It got punctured by Lehman. Okay, we had a drop for several years. This was a period when you got RERA, GST, DMON, etc., etc. But again, we are seeing 3 years on the trot of an increase. The budget does nothing to break this trend. It continues. So that is also business as usual. In between, there was a thought that will consumption move up again. So consumption had a glorious 10, 12 years. Budget mein there is not much for consumption. So very quickly, I think it's the second day after budget, so people would know. Fiscal deficit comes down. Very, very simply put, the way to understand the budget is the government got 1.4 lakh crores extra from RBI. It used 70,000 crores of that to have fiscal consolidation. So versus a 5.1%. In the interim budget, the fiscal deficit that you are getting is 4.9%. The rest of the money and some more, so there are some tax measures which will give the government some money. So rest of the money and some more goes to AP and Bihar. So this kind of gives you what to expect going forward. We are following the same template. So, we are here 4.9, 4.9. The next one is expected to be 4.5. So, when we do a 4.5, it is going to get tougher as we go forward. But yeah, that this seems to be the roadmap as you go forward. Now, the budgetary numbers, the assumptions we believe are conservative. So the revenue numbers are expected to go up in line with the GDP growth, nominal GDP growth. While there is tax buoyancy that is witnessed, the numbers that are assumed is lower than what has come in the first quarter. So we believe it is conservative. There is an element of refunds which makes the picture more complex, but still we think it is conservative. Now just look at this. The messaging is very clear. The government keeps the focus on nation building. So if you see this line, it continues to creep up. Subsidies go down. So visually, the trends continue. No change in that. So, just feed into what I spoke of. But the major reduction that you are seeing in subsidies as a percentage of GDP, subsidies are maintained interim to now, but have declined for fertilizers. Now, this is a function of oil prices. So, if oil prices are lower this year versus last, then this number is not required actually, and it will go down. This is where the stress on account of higher oil prices is seen. Well, if oil prices move up, it can move up, but for the time being, they have done the, this chart is possible because of majorly this reduction. Well, rural spending growth is not much, so it continues to be urban focused. The other big thing is, at least as a part of the budget document, they continue to find more money for Capex. So Capex is a part of total increases. So we spoke of Bihar and AP. So AP capital 15,000 crores. For Bihar, few expressway 26,000, new power project and so on is how the money has been moved. Okay, now roads are seeing some bit of slowdown. Here the bump in road was very, very strong. Roads are seeing a slowdown, but this is something we commented on before the budget itself. Earlier, the projects used to be cash contracts, balance sheets were not good. Then it became annuity. Now more and more budgets, more and more road projects should be seen to be given on BOTs, which will not strain the government balance sheet at all. So this is how it is. I think the buoyancy in other spaces is there. Railways get good, metro, whatever is needed is being done, and so on. In defense, there is more detailing as we go forward. In defense, air gets much more than other spaces. So this I have explained. Now overall, if you see center, states and central PSUs, overall public sector, we are back at 6% kind of capex, which is good. We have been higher than this for only 4 years in this period. So still some way to go. I think as the capex theme gets stronger, I think everybody will pull up socks a bit more. Uh, Now, coming down to capital gains, the bad news is that they got increased for equity. They're definitely trying and destroying sentiment there. But the good thing is now it is all harmonized. So everything which is long term except debt is 12.5%. So if they increase, I think everybody else will cry along with the equity guys at the same time. We won't be the loan guys crying. Similarly, on short term also, while people think it can go to marginal, like in debt, but no, short term for most spaces, including listed bonds, including gold, REITs and InvITs, which is property, has been 20%. It is more towards 20 that is happening. On top of it all, equity also pays STT to the government, which other asset classes don't. Equity dividends are double taxed, one in the hand of the company and in the hand of the individual. So equities are really getting the stick. But I think uh, 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 this is the last that we see. Worst case, we say maybe a 1 year LTCG becomes 2 year, but worse than that should not happen as we go forward. Now, for real estate, indexation benefits have gone. Whether it is good or bad, well, if you expect real estate price CAGR to be over 10%, so if it is 5%, if you are assuming, then it is bad, you pay more tax. If it is 10%, it is where the break even is. If you think any number more than 10%, the new tax regime is beneficial for you. So this is a reality check, guys. Government also doesn't expect real estate prices to move over 10% CAGR deeper into the future when you make asset allocation decisions. Okay, so here just see renewable energy is a large increase, which is good. Housing, rural housing, PMAY has seen a large increase. Otherwise, most spaces are what was there in the interim. In railways, more or less the numbers are the same as interim budget. Spaces which are seeing some improvement is gauge conversion, where it is this thing, traffic, some small increase. So, in the same stuff, they are increasing or decreasing basis the experience of last 3 months. Overall numbers stay the same. In defense, which is again something that we are looking at, just look at the bump up in aircraft. So the way the government works is every year, depending on how much they expect to procure. So one bit is ordering. So some money goes as order for the counterparty to start work. But then, as the aircrafts get manufactured, as the ships get manufactured, it is like you do it for houses. Every slab you will pay some more is how it happens in any contract. So, but yeah, this number is a large number. And it maps to what you can see or what you hope to see in a profit and loss of HL. Valuations, well, yes, larger caps are fine. So when we say larger cap valuations are fine, it means market should do in line with earnings growth. Mids are looking expensive, but just look at it. Larger average is 20, mids average is 17. We showed you mids are seeing higher growth in earnings. Now, higher growth in earnings means that this line should have been higher. It is lower because in the 2000 to 2020 periods for 20 years, mid-cap earnings were lower than large cap. It's changed only for last 3 years. Small caps have been higher, even more higher, but here, the average is even lower. Okay, so ये जो है ना, I'll take you back to the same slide. The averages talk about this period. When large did 5, mids did 4, smalls did 3. They're not talking of this period, and this is the big intervention, guys. Things have changed after COVID. The ability of the government to provide support has increased massively, and it continues. So one has to see numbers in the context. Yes, higher than average, but they need to be. How much is here? It is do it for yourself. If a company does 15% growth and instead of 15 does 20, the valuations move up by 26%. 1% higher growth in earnings for 10 years is a 4.7, 4.8% higher valuations. You can use this table for implications of tax increases also. So if you are a long-term investor, 2.5% more tax, you expect markets to give you 20%. Suppose it means 0.5% impact on your take. 0.5% impact means 2.5% impact on market levels. So this can be used for that as well. Now we say valuations should be higher than average even for larger caps. One, because earnings growth is higher, and two, because the next change in interest rates is down. After the budget, since the demand, the fiscal deficit is lower, there has been a downward pressure on yields in India. It's moved from 7.2 to 3 months back to sub 7 levels. As we get more money in from JP Morgan bond index inclusion, it's a $2 to $3 billion on the trot every month. I think lower yields here will continue on 10 years, which means discount rates are reducing, and that makes equities a good asset class. Now, we spoke of EMS. EMS, for example, benefits from the handholding government is doing for employment. 3,000 rupees in the pension they will put, 15,000 rupees one time they will give. I think EMS companies benefit, and on top of it, there is details will come, but sizable sums of money, 13 plus thousand crores have been earmarked for PLI. Maybe it is to do with people who won it earlier and this is the year of payout, but it could also mean something for newer schemes. Okay, what are we doing? Very quickly, we are out and out growth investors. We run some of the highest growth in earnings portfolio in the country. We want you to pair us with the best exponent of value, and then we think the train goes fine for you. If you ask us, we believe the time for growth is coming. If you see the last quarter numbers, it is there in a smaller part now, which means companies with higher growth quotient should be expected to command a premium. At least that is what our thought is. We follow the QGLP philosophy, fish out themes where growth will be higher for 3 to 4 years, at least by 2 to 3% over the index. Now we will come to all of them when we show the portfolio to see how the budget has impacted each space. So this I think we spoke of in terms of, yeah, we spoke of all of this already. Okay, so what we don't have. So for FMCG, we showed you nothing, but for cigarettes, nothing is good news. Like equity guys, cigarettes is the other space which continues to see or continues to dread a budget because of higher taxes. At least they can celebrate no changes there. Metal mining, stainless steel, there is some small benefit because of BCD removal on ferronickel, but small. Aluminum and zinc, guys, it's okay. It's just that silver duties may have gone down. So this is an associated metal. So the zinc guys may get negative. Cement, if overall capex number is the same, it doesn't get impacted much. PMAY has increased, so maybe small positive. Banks and NBFCs, nothing. Pharma, nothing. Oil and gas, negative versus expectations. Because the APM gas, the gas which India produced and was made available to these guys at lower prices is reducing, and yet there is no support from the government to take care of that expense. Similarly, the under recoveries on LPG and so on. We are simply not there in this space. So I think that covers the budget for you and the direction of the market. I think nothing changes. It is business as usual. But yeah, ठीक है. with some pinch that has happened because of long-term, short-term tax increase.
Absolutely. So this was a very enlightening presentation, sir, and a lot of information in such a compact manner. This was absolutely awesome. I just have one last question for you, maybe, which is a three-part question. If you could give us a summarized, conclusive advice for A, those who are new to investing, B, those who are currently investing and holding and continue to invest more, maybe in SIP mode, maybe otherwise, and those who are in a mature stage of investing, if you could summarize and advise for each of these segments who are our viewers out there. It can be related to this event,
Think,
budget event, or otherwise.
so budget, like I said, there is a trend towards capex driven growth that doesn't change. With some tweaks, it continues. So if you are looking to invest, please do. So the threat is gone. We have seen a correction of 0.5% to 1%, like I explained, 2.5% increase in tax. If your expectations were 20%, lowers your take by 0.5%, which, if the market has to adjust, it should adjust by 2.5%. So there is some adjustment which is left. We got zero point 0.7 on the first day. We got some bit yesterday, and we are getting some bit now. So sum total would be closer to 2. We should expect to see some more correction on this count, but not much. It's the thought. India is a growth story like no other globally. Lots to look forward to. So on a much larger base, uh, uh, this country should be able to grow faster. You spoke of young investor, mature investor. So let me just put a, simile with a life cycle of a human being. So when somebody is a kid, tries to run fast, but it falls hell of a lot of time. We were that way. We got into a lot of issues in the 90s. Every 2, 3 years, when we wanted to stand up and run, something wrong would happen and we would fall. The kid grows, becomes a youth at 14, 15, 16 years of age. Suddenly the world loves him, his parents, aunties, uncles, everybody loves this. This is the age when you are most loved in your life cycle. And this is the age when you can run the fastest. Okay, so all the champions are, 15 to 25 kind of age. Look at India. Russia loves us, US loves us, Israel loves us, Palestine loves us. So in many ways, we are in our mid-teens. And if I then explain on a higher base of the economy, this is a period when we can run probably faster than when we were younger. And X of success getting into our heads. I keep saying this, we have done it in the past. Find the axe and put your foot on it. I think the next 15, 20 years, just like it is for a kid at 15, up till 35 is his time under the sun. I think next 15 to 20 years is our time under the sun. Now, if I take the same analogy forward, the audience may just get help. People keep comparing valuations. If you look at Japan, it is old. Europe, it is old. There the valuation should be expected to be lower. US and China are both young and old. So they have young companies with very high growth quotient, but they also have some very old companies. Now, growth is what brings in valuation, growth and longevity of growth. So if you see price earning ratios across the world, some bit of understanding can happen, because that's the other thing that goes on in the market. PEs in India are higher. It needs to be higher because the certainty of growth, the longevity of growth in India is probably longer than other spaces. Uh, in the same context, I would say countries around us, for example, Pakistan, Bangladesh, Sri Lanka, Thailand, are younger, so they have a lot to look forward to. But whether they will reach there or not is not certain, because you are very vulnerable. You are full of enthusiasm, but you are very vulnerable when you are a child. So that is how it is. So if that helps set the context. So if you believe in the India story, if you see people happy around you, if you see your management talk of the future with a lot of hope and positivity, then people are feeling good about the future. Equity markets reflect that, and you should invest into equities.
Absolutely, sir.
Otherwise, not.
Absolutely, sir. This was very informative, very enlightening, sir. Thank you so much for your time, and I hope you'll allow us to learn more from you in future.
Thanks.
Investment market are subject to market risks. Read all related documents carefully before investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.